Hold on tight, folks. The stock market took a wild ride last week, and the pre-market activity today is trying to smooth things over. But will it be enough? Let's dive into what's moving the markets on this Columbus Day or Indigenous Peoples Day, October 13th, 2025. And yes, we acknowledge the holiday name often sparks debate, a sign of how history is constantly being reevaluated. Today, we're kicking off the week with a relatively quiet economic calendar. No major reports are scheduled before the opening bell. The real excitement begins tomorrow as the first wave of major banks, including titans like JP Morgan Chase, JPM, Citigroup, and Wells Fargo, WFC, unveil their Q3 earnings. Think of these reports as the first glimpse into how the economy performed over the summer. From that point forward, earnings will be in the spotlight. Many analysts believe earnings reports will be the primary driver of market volatility. A string of better-than-expected earnings results could be a shot in the arm for the markets, providing confidence that companies are navigating the current economic landscape effectively. But here's where it gets controversial. Some argue that focusing solely on earnings ignores other critical factors, such as geopolitical risks or shifts in consumer behavior. With the federal government still in a shutdown, Q3 earnings will offer one of the clearest pictures we have of the recent domestic economic performance. Without government data, these corporate insights become even more valuable. This morning, pre-market futures are showing signs of recovery, attempting to fill the significant gaps created by Friday's sell-off. Remember that President Trump announced an escalation in the trade war between the U.S. and China, triggering a market downturn after a week of optimism that saw the major indexes reaching fresh closing highs. On Friday alone, the Dow Jones Industrial Average plunged by minus 1.9%, the S&P 500 dropped minus 2.7%, and the Nasdaq Composite plummeted minus 3.5%. It was a rough day. As we approach the opening bell, the Dow is up plus 356 points. The S&P 500 is up plus 77 points, and the Nasdaq is up plus 429 points. The Russell 2000, which tracks small-cap companies, is also up plus 37 points. While these gains are encouraging, they don't fully erase Friday's losses. It's still early, though, so let's see how the day unfolds. In the bond market, the yield on the 10-year Treasury note has edged down by about 1 basis point BPS to 4.06%, while the 2-year Treasury yield has decreased to 3.53%. It's worth noting that bond markets are closed today in observance of the bank holiday. Now, let's delve deeper into the trade war. U.S.-China trade deals farther away than advertised. Initially, it seemed like President Trump was on the verge of another major victory, a significant breakthrough in the trade dispute between the U.S. and China. However, China's tighter control over rare earth exports, critical components in many electronics, apparently triggered President Trump's frustration. In a Truth Social post, he threatened to raise tariffs on Chinese imports by a whopping 100%. This action appears to be an overreaction to some, and we know by now Trump operates on a less demure, more emotional level of governing than any U.S. president who preceded him. But markets, which had been climbing all the ladder rungs to new closing highs seemingly every day, took this as a palpable warning sign that all might not be well in paradise. And any additional tariffs on the plus 30% already slapped onto Chinese imports will only increase costs for American consumers. And this is the part most people miss. These increased costs can stifle economic growth and impact company profitability. NABE private GDP outlook improves. The National Association of Business Economics, NABE, has released its latest economic forecasts for the remainder of this year and next. Based on the view that tariffs will have a diminishing inflationary effect, the forecast for U.S. GDP growth in 2025 has been revised upward to plus 1.8%, a half-point increase from the previous estimate of plus 1.3%. The forecast for 2026 has also been raised by 30 bips, from plus 1.4% to plus 1.7%. Despite the improved outlook, tariffs remain the biggest perceived threat to the U.S. economy, according to the NABE survey. Simultaneously, the report highlights a significant slowdown in job growth, aligning with recent employment data, which has been unavailable due to the government shutdown. The core personal consumption expenditures (PCE) inflation rate for the full year 2025 is now projected at plus 3.1%, consistent with previous government estimates. For 2026, the forecast is plus 2.5%, which aligns with the Federal Reserve's projections in its latest dot plot. Non-residential investment, which includes spending on things like AI infrastructure, is estimated to grow by plus 3.8% this year, demonstrating the continued impact of the AI boom on the economy. Fastenal misses Q3 estimates, ad content removed. So, what do you think? Are pre-market gains a sign of a genuine recovery, or just a temporary respite before more volatility? Do you believe the trade war escalation is justified, or is it a reckless gamble with the economy? And how will the government shutdown ultimately impact the accuracy and reliability of economic data? Share your thoughts in the comments below.